Hey guys, welcome to the channel. Welcome back to another live stream. I am streaming live today, guys, with my partner, uh, m- um, StreamYard. I'm with StreamYard today, guys. That's my partner on this video. I got another partner on this video. I'll talk to you about that later. But let's talk about the Fed. The Fed, right? The Fed. This is urgent. The Fed is going to keep the cost of money up there, higher for longer to borrow money, to utilize money, right? Bubble stock market. Yep, I think we got a stock market bubble. We'll talk about that today, and we'll talk about the latest information about the GDP, gross domestic product, right? Why is this urgent? Because we are investors. We are consumers on one end and we're investors on the other end. So we're utilizing money here, but we're also trying to make our money grow as investors. And we need to be aware of what's happening amongst the factors that affect our investments. Guys, appreciate you being here. And as you come in the stream, do me a favor and smash the like button for me, just as a as an automatic. Boop, just hit that little thumbs up for me. And at the same time, let me know where you're checking in from and let me know that you can hear me okay. I had some audio issues the other day ago, and I want to make sure that those are solved. So give me a heads up. Let me know that you actually can hear me and you can hear me well. Mrs. Moore is checking in. I appreciate you, Mrs. Moore, for being here from Atlanta. Thanks for the thumbs up. Rhonda, good to have you from Dallas, maybe DFW Metroplex. And we got Kimmy checking in from San Antonio, also in the Texas area. Appreciate you being here, guys, as you come in. This is going to be a conversation about the Fed, the Fed, the Fed, because the Fed is at the point, guys, where they're probably going to more than likely delay rate cuts. I'm going to talk to you on this video about what that means, guys. We get together on Thursday afternoons at 4:30 normally. I decided to push it out to 5 because I keep getting these messages from people that say, I missed a live. I missed a live. I don't want you to miss it. So I pushed it back 30 extra minutes. I want to try to be sensitive to people who are getting off work or, may miss the live or something. I want to make sure you have plenty of time to check us out live. So we're at 5 p.m. today, and we may be moving forward, be at 5 p.m. On during the week as well. But I'll keep you posted, guys. Appreciate the thumbs up. Looks like we got a few of them there. And yes, what's up, Smart Money Bro? LD Sims is also in San Antonio. We got somebody from Madison, Wisconsin, way up north, where it's probably still a little chilly. West Virginia's checking in. Philadelphia in the suburbs of Philly. Greatman 61, good to have you here. Oh, yeah, Barbara said it's 6 p.m. Eastern time. You're right, Barbara. So I guess if you're on the East Coast or if you're in the UK or somewhere, it gives you plenty of time. I guess I'm looking out for my Midwesterners and my Mountain Timers and my Pacific Timers, right? But looks like Levine is in Levine, Arizona. Good to have you here, Doris. So let's talk about it, guys. I want to first, of course, appreciate you guys being here. We got a special show coming up this weekend to show my appreciation for you guys. Be sure to tune into that. We're going to be Saturday at 11 o'clock a.m. Central Standard Time. And then we'll probably be Sunday as well, right? But again, welcome in, guys. We want to talk about this delay of rate cuts and what it means for us as consumers and us as investors. And then, of course, we want to talk about the fact that the stock market is killing it right now, guys. But I don't want us to get ahead of ourselves. It looks like there may be a bubble here that's happening in the stock market. And we want to talk about stocks being potentially overvalued, right? And then, of course, I want to talk about the latest GDP, right? That just came out, and maybe some Q&A after that as well, guys. But if you do that, if you go along in the chat and you put something in the chat and you have a question, please do me a favor and put a Q next to it in the chat as I go along. I'm going to look at the chat periodically. This won't be a long live today. So again, guys, as you come in, smash that like button for me. I just enjoy saying that, guys. Smash that like button for me, if you can, guys. And also, you can always feel free to share uh, the link to the video with your friends, your family, your network of people. Maybe you run a Facebook page or you run some type of other page somewhere on some social media platform. Please feel free to actually put the link in there as well. We just want as much information to get out as many people as possible is kind of what we like to do, guys. So urgent information for investors and consumers. What's going on, right? Let's see here. Kathy's in the house from Pennsylvania. Good to have you, Kathy. We have Sir Mac from LA. We got Maddie Chishamba from Quebec. We got New York City in the house. What borough are you in, Daniel? Manhattan, Bronx, Brooklyn, Queens. Let me know which one you're in. Just curious. Guys, I used to be a geography teacher, so I like maps and stuff like that. Appreciate it. Check the logic. I appreciate it. Check the logic. Smash the like button. Have you smashed the like button? That's the question before we jump in and get super duper started here, guys. Let me just do a check. We got to have more likes than that. Right now, we got less than half the people in the chat who've smashed the like button. You got to hit that for me, guys. It really helps out. So let's jump into this rate cuts that we have going on. This delay of rate cuts. And I put that on the front of the thumbnail for a reason, guys. Daniels, Manhattan, Kansas. Manhattan, New York. Although Manhattan, Kansas does have the little apple there, right? New York is the big apple. Manhattan, Kansas is the little apple. East St. Louis in the house. Good to have you, East Boogie. Appreciate it, Rhonda. Okay, so delaying the rate cuts. I'm going to look at an article real quick. Let's see here. Where's an article at? Let me find this article real quick. I want to look at this delay in rate cuts and have a conversation about what's going on with the Fed. Why is the Fed delaying rate cuts? Right? Give me just a second. I'm going to pull it up here. Boom, boom, boom. All right. I'm so slow with this. I got to get better at presenting my screen, guys. I'm super slow when it comes to it. All right, so I think I'm sharing this article with you guys real quick. Don't sweat the prospect of no Fed cuts. Markets are going to stay higher. Markets will continue to rally. This is for us investors, right? About the fact that rate cuts are staying the same right now. I guess let me just see something real quick, see how that's presented. Let me make that bigger for you guys so you can follow along a little better. And let me go here. But basically, guys, the American people, the American investor, as I go through this article in just a second here, the American investor has sort of been hamstrung, so to speak, in terms of the ability for us to borrow money on things like car loans, credit cards, those things. The interest rates have all been high, including mortgage rates, right? We're not going to be relieved of that anytime soon based on what's happening with the Fed, right? And we may not be relieved of those high rates and a high cost of money anytime really in the next 7-8 months. We'll see. We might get a rate cut coming up. We may not. And it's looking like the Fed is going to delay the rate cuts. First of all, they've already been delayed, right? But they're going to delay cutting the Fed funds rate even further, right? And I did mention mortgage rates, guys. Just by the way, mortgage rates are not directly tied to the Fed funds rate like the short-term rates. Auto loans, credit card loans, small personal loans we may get from a bank or what have you, a lending institution. Those loans are considered short-term rates, and the Fed funds rate really is directly tied to the short-term loan rates, right? Not necessarily anything long-term like mortgages, but there's an indirect tie into mortgages, right? As the Fed fund raises their rates, typically the 10-year treasury that controls primarily mortgages, that goes up as well in terms of that rate. So I just want to clear that up before you guys say, no, the mortgage rates don't have anything to do with the Fed funds rate. Not really, but it's kind of indirect, right? But all these loan rates have gone higher than we've been accustomed to in America in the last 15 years or so. The rates for loans or the cost of money, right? If you look at 50 years of data, the interest rates are about normal right now, right? But the last 20 years of data, the interest rates are pretty high. 15 years or so, the interest rates are pretty high, right? So the Fed is kind of reconsidering some of their earlier forecasts that said we're going to make 3 rate cuts in this year, right? they're kind of hedging back on that a little bit. Is that hedging the right word? But they're kind of pulling back on that just a little bit ago. 2 or 3 months ago, this was the thing. Oh, we're going to do at least 3 rate cuts this year, but it's not looking like that's going to happen right now. So we're clear. The Fed funds rate is between 5.25% and 5.5%, which is a 23-year high for the Fed funds rate. So the Fed funds rate hasn't been this high since right around the turn of the century, guys. It's been a long time, almost a quarter of a century since the Fed funds rate was this high, right? And again, the Fed funds rate is always a range. So it's between 5.25% and 5.5%, right? So, more of the people that are involved with actually setting the rates on the federal funds or the Federal Reserve Committee that sets the rates, more of those people are sort of implying, right? Sort of implying that maybe no rate cuts this year is okay, or maybe 2 rate cuts this year is okay. And so that kind of indicates that it's likely, I won't say likely, I'll say that it's possible that the Fed is going to delay cutting their rates. They won't cut the rates for a while, right? Let me just kind of look at this article real quick and go over it, guys. Markets will continue to rally. This is for us as investors. Markets will continue to rally if the Fed Reserve chooses not to cut interest rates this year, according to Stephen Blitz, chief U.S. economist. His comments come as investors await the release of further U.S. economic data and closely monitor clues from the Fed officials about rate cuts in 2024. Last week, the U.S. Fed left interest rates unchanged again for the 5th time, as we talked about last week, right? So it kept the overnight benchmark. Now, the benchmark, they said benchmark overnight borrowing rate, because the Fed funds rate is just a rate that each bank charges other banks for overnight lending to one another. That's why they call it the benchmark overnight borrowing rate, right? The Fed also said at the time that it still expects 3/4 percentage point cuts by the end of this year. That's sort of what they indicated at the meeting last year. Of course, there's been several other Fed presidents come out in the last 4 or 5 days that kind of spoke contrary to that, right? So the message fueled a market rally. All right. Of course, the market was already rallying before that, and it continued to rally since that. Asked on Thursday about the likelihood of one or no Fed interest rate cuts this year, Blitz said that it's getting pretty good. It's getting pretty good. That 0.4% month over month is a high number, and they're looking at that. They're not just looking at year over year. Really, what is going on here is an evolution, right? The Fed, he's speaking of Fed, quotes, they have already told you they're not going to hike rates to try to shorten that timeline of getting to 2%, which is 2% is their target. So if you're in the market, you're like, well, that's okay. The key is let the markets figure that out rather than the Fed imposing that view. So in other words, guys, traders are currently pricing in roughly 55% chance of Fed's first rate cut in June. So what that means is the market itself has already put a number on the likelihood that the Fed will actually start rating cuts or cutting rates starting in June. Now, that figure was 70%, right? Last week. In just this week, the Fed's likelihood of actually not decreasing rates in June has gone down already. As we get closer and closer to June and more of these, or actually they have another meeting coming up in May, it's almost a given that they're not going to change or reduce rates in the next meeting. But June is 2 meetings from now, right? The likelihood that they're going to cut in June is coming down. As more indicators come in, guys, it's possible by the time we get past this next cycle, this next Fed meeting, the chances for them cutting the rates in June may go down even further, down to 45 or 35 or 25%. In other words, the likelihood that they will delay cutting rates is increasing, right? Blitz said markets will likely continue to march higher even if the Fed decides not to impose any rate cuts this year. A prospect that U.S. asset manager Vanguard named as their base case scenario. So the point is, guys, rate cuts are probably going to be delayed, right? Let me stop sharing my screen for a second. Let's see how this works. Boom. Oh, I did it. That's pretty good. Rate cuts are likely being delayed. There's a balancing act going on, right? If the Fed leaves the rates where they've been for the past 8 months, every 5 meetings or 8 months, everything is going to pretty much stay the same. Market's going to take care of itself, et cetera, hopefully. But if the Fed decides to cut the rates too soon, here's the dilemma. And we should be understanding this as consumers and investors. Here's the dilemma that the Fed is facing. If the Fed cuts rates too soon, reduces that Fed funds rate from 5.25 down to 5 or 4.75, right? They reduce it too soon. Inflation, they could kind of lose the grasp they have on inflation. And right now, it's sort of a slippery grasp, right? Inflation's come down a lot, but it hasn't got down to where they want it to be, and it's taken longer and longer. Sticky inflation is what they call it, right? It has not reached its 2% mark, which is their target. But what happens if the Fed waits to cut rates and they wait too long? High interest rates, 5.25 to 5.5%. Money costs more to get our automobile loan, to get our mortgage. All those things cost more. If the Fed waits too long before they cut the rates, it could trigger some type of recession. That's the fear. I don't think that would happen, but they think it will happen, right? And they know they got more data than me. I'm not an expert, right? Purchasing power goes down, demand goes down, people stop spending, perhaps a recession. We've been talking about a recession for a year and a half. Haven't really even been in a textbook recession, just so you guys know, right? But the inflation readings for the first couple of months of this year came in higher than they thought they would, right? And that's where the dilemma rises. The dilemma comes in. Inflation is still a little bit higher than they want to see it, right? Meaning that it's been sticky in some areas. Services, obviously housing, you look at rents and things like that. The cost of shelter has been way too high, and it's been high for a long time, and it keeps going up and up and up. Gas is gone up, right? I think they said, I read something that said gas and housing was like 60% of the CPI, of the rise in the CPI in the last month, right? And so CPI, which measures, our measure for inflation, it was higher. It was higher than it was last year. So inflation ain't going nowhere as soon as we thought it would be going somewhere, right? Also, the Fed has another measure besides CPI. They got the PCE, right? That's still higher than they wanted it to be as well. So the delay in the rate cuts, the Fed putting a pause on these 3 rate cuts, is going to affect the loans for autos, credit cards, and indirectly mortgages. As I said, right? All that stuff is kind of hanging in the balance, waiting on to see what the Fed is going to do, right? Waiting to see what happens with the rates, right? Remember, this is the key to remember all this. Rate cuts, when the Fed lowers the Fed funds rate, that's an inflationary measure, guys. It's inflationary by nature, okay? So they don't want to do an inflationary measure, cutting rates, while inflation is still high, right? Because what happens is when that rate goes down, that Fed funds rate goes from 5.25 to 4.75, right? People are incentivized to go out and do what? Spend more money. The cost of money went down. Yay. Let's go get that auto loan. Let's go get that personal loan. Let's go ahead and swipe our card with no problem. The rate's no longer 20%, it's 18%. Let's go ahead and spend more money and spend. And when we start spending, not that would happen in that fashion, I'm being a little dramatic, right? But when we start spending the more money, demand for goods and services goes up. And as demand goes up, prices go up. That's inflationary. That's the cycle. That's why they don't want to just start slashing rates. They start slashing them too soon, it could maybe cause some issues, right? Right? So that's where we are, guys, with the Fed keeping the cost of money high for now. Maybe, in my opinion, we might look at 1 or 2 cuts this year if things continue the way they're going. I don't even know if June is a cut. I don't think June is a necessary automatic cut. And the markets sort of agree, obviously, because Around 50% of the market says they've priced in that the Fed will in fact cut. So half and half right now. But as we get closer to, first of all, we got a meeting in May. The meeting in May, I don't think they're going to cut rates. I think that's a 90% chance is what the market's already priced in for May. But June, we'll have to see what happens, guys. Do me a favor. You got to smash that button, that like button below, guys. Also, look in the description box. I have my partner in crime on this one, Mint Mobile, largest 5G network. Check them out as well. They're in the description box. And don't forget to check out also your 24 Laws of Money free ebook from me to you. Check that out in the description box. Also, you want to also see in the description box links to join this channel, links for one-on-one financial mentoring and coaching. All that stuff is down there. Check that out for me too, guys. So that was a quick commercial break. Let's talk about this possible stock market. Now, there's potentially, guys, a stock market bubble that we are currently in the midst of. I don't know if any of you have checked your investments lately, but let me know in the chat how your investments are looking right now. How are your current stock market investments, individual stocks, ETFs, index funds, mutual funds, how are they looking right now? Let me know. Looking great, looking bad. Give me a thumbs up. They look great. Give me a thumbs down. They look bad. I can tell you right now, I'll be the first to put a thumbs up in the chat, right? First to put a thumbs up, right? Hey, Brian from South Africa, good to have you in here. Salute from Baltimore. Jay, good to have you in here as well. New York City again in the house with Mr. or Mrs. Ortega. Colorado. John, Denver, great name, right? In Colorado. Thumbs up. We got to get the thumbs up, guys. Stock market is killing the game right now. Killing the game. The stock market is up, guys. But I want to point out to you about the stock market is don't get too excited, right? Don't get too hyped over the stock market because let me show you. Let me show you an article real quick, guys. I want you to be a little grounded when it comes to the stock market because I really believe that we are in a stock market bubble. Not a big bubble, not a huge bubble, but I think there's some overpricing right now in the stocks. Like there's a number of you that put a thumbs up in there. Appreciate you. You have a couple of well-known indicators right now. I like to look at, since I'm an ETF and an index fund person, when I look at indicators of the stock market, I look at sort of overall broad indicators as opposed to, individual indicators for individual stocks. I look at sort of these broad indicators, right? There's a couple of them that are kind of important, and you can Google them if you have to. I don't want to dig too deep into them right here. But yeah, a lot of thumbs up in there. Everybody's looking good, right? But there's the Buffett indicator. The Buffett indicator is how Warren Buffett kind of looks at the overall picture of the overall stock market, right? The total stock market. It's a ratio of the total stock market's capitalization, which right now I think the total the total stock market capitalization is around 52 trillion dollars. It's a look at that total number, how that relates to the GDP, and we'll talk about the GDP in just a bit. But how does that number, that overall cap of the overall stock market, what's the ratio of it to the GDP? Currently, this ratio, what's called the Buffett indicator, is showing that the stock market is slightly overvalued right now, right? Slightly overvalued as an entire market. Now, the other one is Morningstar's price fair value ratio. They use the price fair value ratio when they're in, you can do it with individual stocks. You can do it with a bucket of stocks, right? It's usually used for an individual stocks. But if you apply it to a total market analysis of the total market, it's also showing that the stock market itself is, I think there's a 1.0 middle ground there, standard, and you can deviate from that above or below. And if you go above more than, if you go above the 1.0, it indicates that a stock, or in this case, a total stock market, is overvalued. And I think that's sitting at, like, last I checked, 1.2 or something like that. So that's another indicator that the stock market in itself is slightly overvalued. But I want to share a link with you. I want to look at an article real quick on Yahoo because I want you to sort of see what I'm talking about. All right. Again, I'm going to try this share the screen thing, right? And if you're not on YouTube, I like to share my screen. So that's always a good thing. All right. So the bizarrely overvalued stock market is poised for a big correction. I mean, and I think this article just came out yesterday, right? Poised for a big correction, guys. That's important to note, right? Well, what is the article saying? Let's kind of run through the article and kind of see what it says. It says basically indicators are pointing to a major correction coming for stocks. There's a market strategist, Paul, who said that. The B. Riley Wealth chief investment strategist says the market is bizarrely overrated. This is the stock market. So I know we're hyped. We're happy. I need you guys to also try to take a more Tim Duncan approach to the stock market. Okay. As an average everyday investor, consumer, as an investor, take a Tim Duncan. Anybody know who Tim Duncan is? You guys know who Tim Duncan is, right? Tim Duncan. Tim Duncan was a basketball player for the San Antonio Spurs, right? And Tim Duncan was a player that you never seen him get too excited and you never seen him get too down. Anytime he played, he was sort of the same person the whole time, just kind of even keel, level-headed person on the basketball court, right? His emotions didn't get to him. This is the type of investor that we need to be. Our emotions cannot be getting to us when it comes to how we invest in the stock market, right? Jay Samuels, Mr. Fundamental, absolutely. The fundamentals, right? That's what we need to be employing as investors, as retail investors, right? We're not big institutional investors. We're not Fannie Mae. We don't have $20 million in the stock market. We're just regular retail investors. So we have to be Tim Duncan on the court of investing in the stock market. We got to be fundamental. And one of the fundamentals is don't get too high, don't get too low, take the emotion out of investing, right? I'm going to show you something here in this article here. So in this article, I don't know if you guys can see this very well. I want to make it bigger. I don't really know how to make it bigger. Let me go in the corner. That'll help you out a little bit, I guess. So in this article, it says, and I'll just run through a little bit of it. The stock market took a bizarrely overvalued looks bizarrely overvalued, and indicators are pointing to a big correction. So down here it says, speaking to Yahoo Finance, Dietrich pointed to a handful of indicators in the market, which are all flashing a collective warning sign for stocks. You got to know this. Red flags are rising in the price to earnings ratio of the S&P 500. So just looking at the top 505 or 506 companies that make up the 500, the S&P 500, there are some red flags, right? The S&P 500 is a pretty good measurement for the entire stock market, right? We know that it's a little top heavy with tech, obviously, with the Mag 7 being in there, but the S&P 500 is still, if you look at a graph of the S&P 500 with the total stock market, they pretty much follow the same thing on the graph. So when you measure the S&P 500, you're essentially sort of measuring the overall stock market. So there's red flags that are arising based on some of the indicators, and put specifically the PE ratio of the S&P 500. It says every single indicator seems to tell us we're in a historic bubble. It's hard to look at that and say that we're not going to see a major correction coming. Now is not the time to be putting new money in the market, he warned. Now is not the time to be putting new money in the market. Let me explain what I'm saying here, guys. So he didn't have to say this for us to know that there's a major correction coming. Why? Because there's always major corrections coming to the stock market. Duh. We're smart consumers. We know that it's going to go up, down, up, down, up, down, up, down, up, down, but eventually it starts here, it ends here. It's going to go up, down, up, down, up, down. I just like doing that. Feels good, guys. You should try it. Up, down, up, down. Listen, the point is this. We know that there's going to be a correction. He said a major correction. He said now is not the time to be putting new money in the stock market. So you're probably saying to yourself, well, man, that makes me think I don't want to be investing in the stock market. You really do. I always tell you the DCA up in here. dollar cost average. Even though we get these warnings, dollar cost average, right? We are not institutional investors that have to pull money, put money. Let's keep going. The biggest indicator of a coming correction is smart money investors, not smart money, bro. Smart money investors who are moving out of the stock market and into safer cash equivalents. He pointed to this. Watch this. Pointed to recent stock sales from billionaires like Jeff Bezos, Warren Buffett, and the Walton family. And we all know who the Walton family is. Not that TV show that used to come on at 7 o'clock at night, not the Waltons, but the Walmart family, right? These large investors. You can throw Jamie Dimon up in there, the CEO of, what's Jamie Dimon, the CEO of JP Morgan Chase, right? So all of these smart money investors that have as much money as human beings that have as much money as whole institutions, they're pulling out lots of money. Billionaires are pulling cash or pulling money out of the stock market into safer cash equivalents, right? Cash equivalents, right? What does that mean? I thought cash was going down in value. Well, there's cash equivalents, not just cash, right? So I just want us to be thinking about what's happening here, right? Investors are moving money into cash and cash equivalents. Large billionaires, not you, not you. Don't pull out your $2,000. Okay. These are billionaires, right? And what are cash or cash equivalent? Treasury or T-bills, right? Money markets, CDs, high yield savings accounts, coins, cash itself, right? Short-term government bonds. These are safer investments where billionaires like this, they put their money in those investments when they see a large market correction happening. Why? Because their money is safer over there getting 3% in the cash and cash equivalents than it is getting negative 20% in the stock market. Their money is safer sitting in a T-bill or a government bond that's going to give them 2 or 3% than sitting in a stock market that's going to give them negative 15%. That's why they move their money out and then move it back in. See what happens is when they move their money out and the market tanks and goes down, guess what happens? Stocks go on sale, right? And when stocks go on sale, those billionaires take the money they pulled out and was getting 2 and 3%, and they turn around and go and invest right back into those stocks that just went on sale. That's the money game right there. Woo! We just dropped the whole money game right there. And if you wasn't here, you missed it. Rewind it back to what I just said. Big indicators are happening right here, guys. The big indicators are the big boys and girls and institutions are pulling pulling money out of the stock market to go put their money in safer places. It says, while sales by investors or big shareholders are often scheduled in advance, they can also be a sign that investors are concerned the market is approaching a peak. There's just no ambiguity here. It's bizarrely overvalued, he said. You're seeing the stock market, the smart money right now moving massive amounts into cash and cash equivalents. It's not that they don't believe in their companies. They do. They know it's just completely overvalued. And if they sell it now, they can buy it back cheaper later. That's what I just said. Right? I hope you guys are hearing this as regular consumers, regular investors. This is the stuff you got to know. Why did Jeff Bezos just, get rid of a bunch of stock? He didn't get rid of a bunch of stock so he can watch out. Oh my gosh, I'm scared. He got rid of a bunch of stock so he could go put that money somewhere else. And when his overvalued stock goes down, because he knows it's slightly overvalued, because he has 100 professionals watching the indicators every day. So he's making that move to pull his investment out of the market Go buy some cash or cash equivalents, put it in a CD or something really, really safe. Really, really safe. We know the T-bill is going to get 2.5%. We know that. While that's happening, the stock market is dipping and it's dropping and it's dropping and it's dropping. And guess what he's doing? He's preparing to go grab it when it drops, when it's near a bottom. He's going to go pick it up at a discounted price. He got a $20 shirt that he knows is only worth $15. He is going to get his money out of that shirt right now, and then he's going to come back and get that shirt when it costs $10. And then when it goes back to 20, he just doubled his money. Are you feeling what I'm saying? Are you anybody picking up what I'm putting down here? Okay, because that's really important for us to know as regular investors. I know we're not institutional investors, but how about let's learn what institutional investors are doing? Okay, he says the article goes on to say it's unclear what could trigger a coming stock correction, noting that prior crashes like the one that preceded 2008 were sparked by unpredictable black swan events, a spike in oil prices, or more regional banking troubles, right? All those things, right? Stemming from the commercial real estate sector. We know that's a big issue coming up. Well, I don't know if you know it, but we've talked about it here before. Commercial real estate sector, right? What's happening there could set the downfall. This is what he says, could set the downfall for the stocks in motion. Commercial real estate, there's going to be $1 trillion that's coming due. And many of those commercial real estate investors, they don't have the money to pay. Why? Because they're losing tenants. If you go to big major cities throughout the country, you see a lot of commercial real estate is empty. Why is it empty? Because people are working from home. They've cut their workforce when people work from home, and they don't need the buildings. And if they don't need the buildings, they don't have anybody to pay the rent on the buildings. And so commercial real estate investors are having a tough time, and it's going to get tougher as $1 trillion worth of those leases are going to be up. What's going to happen? That could spark this whole downfall of stocks in motion, as they called it. So I just want to bring this to you guys' attention because I think it's important for us to know as regular investors, right? Somebody said, my suggestion, put a Q, let me know. And I just caught it because this is the last one. Are you suggesting folks to sell their investments? No, I'm not no, please. I'm not telling you to sell your investments. Not one bit. Please. No, I'm not telling you to sell your investments. Not at all, guys. That's not the point. I'm pointing out to you what's happening. That's all I'm doing is showing you the process by which this happened. I don't suggest those type of things. Juicy work. I appreciate you for dropping the super chat. Actually, it pushed me way back, guys. So let me see what else we got up here in the chat section before we keep going. Let's see. I think they're wrong about their theoretical perspective, Barbara said. Perhaps inflation is still going up in reality, Barbara said, and with interest as they are. It's impossible to make ends meet, let alone pay off debt. I think you've got a point on some of those, Barbara. Absolutely. Let's see here. Jay Steed, debating with switching over from BTI to SPLG. Your choice. We can talk about it in a bit. Mine are looking pretty darn good. A lot of thumbs up on that. Let's see here. The best donut maker ever. That's funny. Juicy work again. Thank you so much for that super chat. I appreciate you. I appreciate you being a part of this community and your support, right? Let's see. Somebody said, if a big correction is coming, then this is the perfect time to buy. Somebody else said, if I'll only worry if they said every single share of stock they own. Right. That's a good point, right? Clint Perry said, that's why you need bonds. I think a lot of people sleep on bonds, and I think bonds ain't a bad deal. We'll talk about that later. Somebody said, Simply Money said, that's why companies do stock buybacks when the market is down. Absolutely. Absolutely. It's all cycles. Mrs. Moore said, yes. Simply Money, absolutely. I hope I answered that question earlier. So investors are moving money. I'm just telling you what the big boys are doing. They're moving their money, right? Cash and cash equivalents. It's something for us to think about. My suggestion for all of us retail investors, my suggestion is just continue to DCA. That's it. Continue to dollar cost average. You don't have to play the game of shifting your money to cash or cash equivalents. You don't have to do that. That's not what I'm saying, right? But as we're all feeling so pumped up, if you guys can remember back to 2022, we had a horrible year in 2022. I think the S&P was down 18%, something like that. Maybe you guys can correct me. So we always get these natural ebb and flows in the market. Your job is to be Mr. Fundamental or Mrs. Fundamental. In other words, just keep doing what you're doing. Don't get too hype. Don't get too low. Whether we're in a bear market, bull market, whatever, just relax, right? You want to be able to get the reason you want to these dollar cost averages, you want to get paid. You want to get paid no matter what's happening. Up, down, you want to get paid. If it's up, you're in the market, your investments are growing. If it's down, you're in the market buying more shares. So you're winning whether we're in a low or a high, you're still winning. That's why you want to keep dollar cost averaging into the market. That just means dollar cost average means putting a certain amount at a certain set interval into the stock market, no matter what the stock market is doing. You're just steady investing over 5 years, over 10 years, over 15. And what happens is you get a chance to enjoy all of the great days. You enjoy some of the low days, but in the low days, you're just buying more. So you're just dollar cost averaging, right? That's all we want to do, guys. That's all we talk about on here is keeping this investing thing very, very simple, no matter what's happening. But I can tell you right now, folks are looking at a bubble. We're looking at a bubble in a lot of ways in terms of the stock market. So yeah, we can enjoy it. Yay, 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 yay. But don't make any emotional decisions when everything starts to tank, right? Appreciate you being here, Seminole. Rewind this thing back here when we finish up and check out the beginning, right? We started off talking about the Fed keeping the cost of money high or higher than it had been for many, many years. Our Fed funds rate is now at a 23-year high. It's been there for 8 months, 5 straight meetings in a row from the Federal Open Market Committee. And so it's there. It's probably going to stay there. And then we talked about this potential bubble that we have in terms of the stock market, right? Now, I want to, somebody said, let me see, when the shirt goes down to $10, he snags 2 of them. Then when the price swings high again, that's when hello, right on the money. That's what we're talking about. Appreciate you, Jeff. I appreciate you being here and supporting as well. If you're not a subscriber, guys, please consider subscribing. We kind of talk about the economy from time to time. And usually once or twice a week, we talk about what's going on so we can be aware of what's happening. But also, we talk about regular money management things on this channel so that we can be better with controlling and managing our money, better with growing our money, better with keeping our money, better with managing it, as I said. So we just do all things money management on this channel, guys. Nothing too specific. And, I've got certain specific things I talk about, but we try to keep it broad because we just want people to be better with their money in general, right? So let's talk about the other thing that was in the title, which is GDP, right? GDP. We talked about before, every GDP is measured in quarters, right? So we got our 4th quarter from last year, our final reading from the 4th quarter. We get an initial reading in January. We get a second reading in February. We got our 3rd and final reading from the final quarter of last year, because throughout that time, those 3 months, they're adjusting the numbers. More data is flowing in and they're adjusting the numbers. And typically the change from the first month, say January of this year, to March this month, usually is minuscule, but it does change a little bit because all the new numbers or all the full numbers have come in. So we got our final reading, 3rd and final reading from the 4th quarter last year from GDP, right? I'm going to share my screen again. I like sharing my screen. I'm actually getting better at it, guys. There's an article I think I picked up from AP, Associated Press. U.S. economic growth. I think I got it there if you guys can see it. U.S. economic growth for last quarter is revised up slightly. Remember, they have to revise the numbers every time they get more data in. So January of this year, the preliminary reading for the GDP for January of this year is going to happen in April of this year. The second reading for the first quarter of this year, January, February, March, the second reading is going to be in May. Then the third reading for this first quarter is going to be in June. Am I saying that right? First quarter, March, April, May. No. Yeah. January, February, March. First one's in April, second one in May, third and final for the first quarter of this year is in June. That's kind of how it works, guys. But let's look at the article. The AP article says U.S. economic growth for last quarter revised up slightly to a healthy 3.4%. The U.S. economy grew at a solid 3.4% pace from October through December. That's fourth quarter last year. The government said Thursday in an upgrade from its previous estimate, right? The government had previously estimated that the economy had expanded at 3.2%. Why is that important? Well, the economy has the U.S. always wants the economy to grow. All governments want economies to grow, right? At a certain pace, right? And so this growth is great. Remember, textbook version of a recession is 2 straight down quarters of GDP. And we haven't seen that, but we've been talking about a recession. I remember doing these videos a year and a half ago. There might be a recession. We thought there was going to be a recession end of 2020, end of last year. It wasn't, right? We're still talking about a possible recession. We don't know. As everything, as some of these numbers are looking good, right? The Commerce Department's revised measure of the nation's gross domestic product, the total output of goods and services, confirmed that the economy decelerated from its sizzling 4.9% rate of expansion in the third quarter of last year. So last year was sizzling 4.9%. It's cooled off, but it's still growing at a 3.2% clip right now. It says last quarter's growth was still solid performance, absolutely, coming in the face of higher interest rates and powered by growing consumer spending, growing exports, and growing business investments in buildings and software, et cetera. It marked the 6th straight quarter in which the economy has grown at an annual rate above 2%. Economy looks and feels strong. Stock market looks and feels strong. Unemployment rate at a 3.9%, still in the threes, still near historic lows, looks and feels strong on paper. But then you go to something, as I think Barbara pointed out in the chat earlier, you go to something like housing, and we're saying, well, housing, gas prices, they're still going up at a higher clip. So and we spend a lot of our money on gas, right? Our biggest expense as individual consumers in America is what? Housing and our automobiles, our transportation, right? So those two things being still higher than the rest of the items that are a part of that make up inflation, still makes us feel like inflation is still high. But really, guys, those are the couple of things that are the most high right now in terms of inflation. I mean, housing prices, and that's a big one. I'm not downplaying it. I'm just saying, other than those two big items, energy, gas, and food. I'm sorry, not food, but rents, housing. A lot of the economy has cooled down quite a bit. The article goes on to say for all of 2023, the U.S. economy, the world's biggest, grew 2.5%, up from 1.9 in 2022. In the current January through March quarter, the economy is believed to be growing at a slower but still decent 2.1 annual percent rate. Thursday, that's today's GDP report, also suggests that inflation pressures were continuing to ease, meaning inflation was continuing to sort of exhale a little bit, take it to, kind of go down a little bit, right? Except for those areas we mentioned. The Federal Reserve's favorite measure of prices, called the PCE, personal consumption expenditures, it rose 1.8% annually in the fourth quarter of last year, which was down 2.6% in the third quarter. You're down from 2.6%. So that PCE rate, here's the kicker. When the Fed says they want to get the Fed funds rate down to 2%, they're not talking about headline inflation, CPI, at 3.2%. What they're talking about is the PCE, right? And if you look at this right here in the article, the PCE was only at 1.8% in the fourth quarter last year. There was a reporter last week that asked the Fed Fund Chair, Jerome Powell, about this, that said, hey, the PCE in the last 3 months and 6 months is below 2%. So doesn't that look like that we've actually reached that 2% target that you want? And of course, Jerome Powell came back and said, well, we still want to be sure, and we're just not quite sure. There's some other indicators, blah, blah, blah. So there, that is a point that some people make, that, hey, we're down below 2%. not on an annual rate, but on a quarterly or semi-annual rate. So just something to think about, guys. I wanted to share that article with you to say, hey, GDP is growing. Not where it was, but it's still above what we would consider to be recession range. And they're thinking that the first quarter, they could be wrong, the first quarter is around 2.1. So what we see is we do see a little bit of shrinkage, right? Let's not say shrinkage, but let's say we see a little bit of not so much growth in the last, say, 9 months, 10 months, 12 months, right? Over 4% portion of last year, down to 3 something at the last quarter, and now they're looking at maybe 2.1 this first quarter. Of course, that reading won't come out in April. So the point is that we're seeing a little bit of contraction in the overall economy, but it's still growing, right? Still growing. So I just want to share that. Let me stop sharing. Let me see how that works. Oh, it worked. Guys, if you have a question, put a Q in the chat. Fed is going to keep the cost of money high for us borrowers, for us consumers. Okay? Keep in mind as an investor, oh, by the way, let me go back because I think I should talk about this real quick. If you're looking to buy a home in the next 6 months to a year, maybe 6 months or this year, you're looking to buy a home, keep in mind that the rates are going to be a little higher because this delay in the Fed funds rate, as we said, it keeps that rate higher, right? There's no direct correlation, but there's an indirect correlation. If the Fed were to come out in June and cut the rate by by 100 basis points down to 4.25, you would ultimately see mortgage rates contract as well, right? Or go down as well, right? Not directly, but indirectly. We know that's not going to happen. We're pretty sure that won't happen. But just keep that in mind if you're looking to buy a home, because I know people who are looking to buy a home this year, they need to be aware that rates may stay a little higher, a little longer. If you're looking to finance something, that's what happens. Okay? So the other thing, the bubble, the stock market bubble, guys. Don't get too high, don't get too low as investors. Just make sure you understand where you are. Stay grounded. Keep dollar cost averaging. If you got a Q, if you got a question, put a Q in there, guys. Let's see what you're talking about. Let me go to the chat now. Somebody said, just started watching your videos this month. Do you invest in T-bills? No, I don't invest in treasury bills. I don't, right? I've got a video coming out that talks about it. It'll come out probably tomorrow and talks about asset allocation, right? How much you should have in this. It'll talk about the rule of 120 as well. How much you should have in stocks, how much of your money you should have in real estate or more fixed assets, right? We'll talk about that on that video. It'll be a shorter video, a 10-minute video, 12-minute video. Be looking for that video. Probably tomorrow it'll come out. Really important video that'll help you guys help explain some of that stuff. So appreciate you being here. McCown. My home taxes went up $1,000 and car insurance jumped $360 for no reason. Listen, when you do your research, guys, you're going to find that insurance at all levels of insurance has really, really felt some of what we're looking at. Insurance prices have gone up through the roof in many cases, guys, be it car insurance, home insurance, etc. So that's something else that we should be aware of. I should do a whole video on that because that's been a big topic kind of behind the scenes. Maybe not on the front page of CNN or anything, but it's sort of behind the scenes in these financial streets out here. Somebody says, ain't that something? Everything going up. Yep. All right. I've noticed increase as well. Yes. Insurance increase. Exactly. I work for a nonprofit that gives no merit raises and no cost of living, no matter how excellent performance reviews are. I'm not sure if she's responding to Kimmy. Barbara is there. Good stuff. I'll look out for it. Thank you. Appreciate that. Can you go over JP Morgan? What do you want to know about JP, Sean? I'm shopping around right now for cheaper car insurance. Yes. One of the things I always like to preach to you guys is make sure that you don't get stuck in some of these old plans that you've had for 20 years and you're just stuck there, right? Do your research every 6 months, every year or so, maybe not 6 months, but maybe every year or so on some possible less expensive insurance, car insurance, etc. You could be like me. I made the mistake of I had everything insured in one place and I was their customer for 15 years. As soon as I looked for car insurance somewhere else, after about 15 years, and this was only 3 or 4 years ago, after about 15 years being there, I looked somewhere else and my car insurance was almost chopped in half. So I left the place that I was with and I went with a new company to cover my car insurance, guys. So I just want to don't make my mistake, right? Somebody says, question, is Invesco QQQ a good ETF? I've heard a lot of great things about QQQ. A lot of good things about QQQ. Let me see what QQQ is trading for right now. 441 QQQ. Let's see here. Yeah, they're up there. 441 is what they're trading at. Let me look at them over the 6 month. Still, yeah, they've risen quite a bit, man. They've done well actually in the last in the last year. QQQ has looked really good. 5 year sharp, yeah, looks good. Invesco's QQQ, I think that's Invesco, right? Is doing pretty well. Let's see here. I'm okay with QQQ. I've heard good things about it. I think it's a good ETF. Is it better than a savings account? Yes. Don't have your money in the only money you should have in a high yield savings account is money that you may need quickly for your emergency fund. That's it. Anything above and beyond the 20,000 or 15,000 or 40,000 that you have in a regular high yield savings account, go ahead and move that over to investing, guys. Don't stick your money in a especially not in a savings account at a bank down the street where you're getting 0.001% interest, right? You're just giving away money that way. You might as well just stick it under your mattress, right? And lose value based on inflation. So yeah, I'd put anything above and beyond my emergency money. I'd put it QQQ. There's nothing wrong with that. Somebody said, can you do a free comparison between TSP funds and low cost index funds? So what if you don't know what TSP funds are? TSP is Thrift Savings Plan. If you work for the federal government here in America, you have a TSP, right? Instead of having a 401k or a 403b, the retirement plan is called a Thrift Savings Plan. And in that TSP, they have a set of, I think, 5, somebody can correct me if I'm wrong, 5 funds that you can invest in. And these funds are just like index funds. They are a bucket, and they're very, very low cost index funds. They're a bucket. You have your C fund, your S fund, your I fund, your F fund, your G fund. There may be another one, but they are just buckets. The C fund is just a bucket. The S fund is just a bucket. And there's really no difference between those buckets in the TSP and any other low cost index fund that you go and get somewhere else. It's not much difference. If you have a TSP, and you can go on YouTube, you can Warren Buffett, John Bogle, they all talk about the TSP. They all say that it's a great, great, great investment tool. So if you have a TSP and you work for the federal government for the United States, congratulations. You're doing well. The TSP is a great place to have it. It's just like having your money in low-cost index funds. I hope that helped you out, Kimmy. Somebody say, I went from Allstate for many years to Geico. Nothing wrong with that. Why is it up, and where is it headed? Bitcoin, they benefit from higher interest rate. Use it as investment. As you guys know on this channel, I'm not a huge Bitcoin guy, okay? I'm not a huge crypto guy. Nothing wrong with learning about it. Nothing wrong with having a tiny, tiny percentage of your money. And when I say tiny, I mean less than 50%, less than 5%, 3 to 4 to 5% of your money in Bitcoin, in crypto, I'm cool with. More than that, I'm not okay with that. Call me. I just have to understand it better. I understand cryptos a little bit, but not as much as I probably could. So if you have a $1 million net worth and you got 50 grand in Bitcoin or 50 grand in Ethereum or 50 grand in Litecoin or whatever, I'm okay with that. But if you got $100,000 net worth and you got 50 grand in Bitcoin, that's a problem. If you have a $10,000 net worth and 3,000 of it is in Bitcoin, I have a problem with that. Not something I would endorse. I would just say be very, very careful about it. But I think I got a little bit of Ethereum, I think I do. I'm pretty sure I do. Somebody said, also, insurance brokers can find companies in other states that you probably never heard of. Yeah, I like the idea of brokers. Absolutely. Somebody said, QQQM is even better than I heard. QQQM is a little cheaper, but, you can buy fractional shares if you buy it off of a certain brokerage account. Let's see. Thank you, Blue Sky. I've been with Allstate 30 plus years. Been there, made that mistake, bro. Too loyal. Yeah, too loyal. It's the same thing with your cable company. If you have cable at your home, right? You're just so used to having that cable, you just keep it. Right? Just like this phone back here, right? So used to having a landline, so used to having a landline. I still have a landline. Don't beat me up. You don't call me too many names, right? I don't really use it, but I just think it's cool to pay the 20, 15 bucks or something, whatever it costs me to keep it around. It's just 15 bucks or something like that. So I just think it's just kind of cool. And it actually works, right? Let's see here. Somebody says, thanks, Kimmy, blah, blah, blah. All right. Yep. Okay. So also the market is rotating out of tech and into ETFs such as XLE. Could be, right? I haven't looked at individual tech stocks recently. Let's see. Geico, count your days. I'm just referring to JP Morgan. What do you mean my thoughts on JP Morgan? Ask that question a little bit differently, Sean. I can give you a better answer. I promise you. Crypto's an environmental disaster. I think when you're mining crypto coins, I think that's what you're talking about. That pulls some type of energy, or I don't know. You guys can share with me. I don't really know. Somebody says I have two policies, and I'm just going through the chats, guys. If you have a question for me, let me know. If you don't, that's cool. But drop a Q and ask a question, because after we talk about the Fed, how that affects us as investors and consumers, and the cost of money, and we talk about the stock market as investors, knowing that it may be in a bubble right now. There's some indicators that tell us it's in a bubble, right? And after talking about what's happening with the broad economy in terms of the GDP, right? Let's have a little conversation, guys, back and forth. But that's really what I want to focus on, is those things, guys. And I appreciate you guys dropping some of these ticker symbols in the chat, because I think it's really helpful for people that are looking. Always do your own research, of course, guys. You don't want to just take somebody's word for it in the chat that QQQ is good or not good. Do your own research over your ETFs and so forth, guys. Somebody says, how do you feel about someone investing their money in a CD that is paying 5%? Well, CDs are not very liquid, right? CD, you're not going to be able to get to your money quickly if you need to get to your money quickly. I don't have a big problem with if CDs is a part of your, or a smaller part of your portfolio, sort of in the fixed assets portion of your portfolio. If you have a few CDs, but I don't want 80% of your portfolio to be made up of CDs at 5%, right? And I know some of this is determined by your risk tolerance level, right? But I like to see CDs. If you have them and you want them, that's cool, but make them a small percentage of your overall portfolio, right? If it's paying 5%, that's cool, and you feel comfortable. See, everybody, we got to remember, personal finance is personal, right? There are some blanket statements I'll make, but in some instances, when it comes to investment preferences, I don't like to make too many broad statements, because everybody's different. Larry, who asked the question, Larry might be in his 70s and may not want the volatility of the stock market, right? May not want the super duper volatility of the crypto market. So I would say, hey, Larry, if you're comfortable with CDs and you like CDs and you can find one that's giving you a 5% return, and you have a portion of your overall net worth, overall portfolio that you can afford to put into a CD. Maybe you have some children. Maybe you're laddering CDs. That's a whole other conversation. But that's fine if that's what you want to do, right? But I would not have 50% of I wouldn't be 50 years old with 50% of my portfolio in CDs. I just wouldn't do it, because I want to take a little more risk than what CDs offer. And I want to get a potential for a larger return than what CDs offer. A 5% CD, Larry, is probably a long-term CD, right? I'm guessing this is 10-year, 15-year CD. I'm not sure exactly what it is. But that's my answer to you, Larry. I hope that helped you out a little bit. It's okay, but not a big percentage. And also, this is based on your age too, Larry. Let's see. When calculating real estate into net worth value equation, do you recommend using Zillow or Redfin for estimated value, house evaluation, or house valuation? I recommend you having a good feel. You do your research. I recommend you go to a real estate agent if you really want to get the proper value. Sometimes Zillow and Redfin aren't the best, right? Sometimes those are not the best. Maybe you need to go directly to a real estate agent, if you know one or two, or who will answer your questioning and just run some quick comparables to you to give you a better idea than maybe what Zillow or Redfin is giving you. Okay. So that's something to think about as well. Let's see. To my understanding, crypto uses up a lot of power to mine. Absolutely, Seminole. That's what I thought too. Somebody said crypto, a pump and dump scam, no value. It's just software. Yeah, pretty much for some folks. Yeah. I bought Mr. Bogle's book on smart investing, LD Sims, that's going to put you in position to really understand the value of index fund investing, the value of index funds over individual stocks. Right. So good, smart move on that, LD Sims. Phil, that's good reading, actually, and good learning there. Let's see here. Is crypto safe? I don't know, old school. I'm not sure. It could be. I'm not a fan of it. I don't use it. I mean, I don't use it. I don't invest nearly nothing in crypto. Right. Let's see here. How do you feel about precious metals? Um, if you understand precious metals, not just because you saw an article somewhere, but if you research, understand, and you want to make that a part of your portfolio, I'm okay. But you guys know I'm a big three guy. I'm a big three guy. Real estate, stock market, owning a business. And essentially, when you own stocks or in the stock market, you're owning portions of a business as well. But owning your own business, investing in the stock market, or real estate, that's the big three, right? Precious metals, if you understand them and you want to put a small portion of your money towards that or a small piece of your overall investment portfolio, hey, I'm okay with that. There's a lot of different things you can invest in, guys, if you're comfortable and you understand the investment and you follow some of the basic rules of investing, right? Some of the golden rules of investing. You follow those and I'm cool as long as you understand what you're doing, right? Let's see here. CDs are normally 12 months. Yep. Question: would you advise someone who is about to start investing to wait? No, I would not advise you to wait. I would advise you to go ahead and start investing, even if it's very little bit. Get going, right? Don't sit and wait around. Don't wait on the market. Don't try to time the market. You ain't that smart. Just go ahead and get in there, right? Do it at a small pace. And then the other thing is do what LD Sims is doing. Do your research, be learning, start reading, not just watching YouTube videos. That's cool, but also you got to get a library together. You got to start building a library of books, things that you can read and digest. Every piece of your learning shouldn't just be quick blurbs on YouTube. Some of your learning should be reading, because when you read, it makes different synapses and dendrites connecting your brain, and it sticks a little bit harder when you read it. Same thing with writing down. I always suggest people, you always take notes, because you can't keep and remember everything in here. But if you take notes as you read a good book about investing, right, you're on your way. And in the meantime, just start a little bit of investing at a time. So I hope that helps you out, Maddie. Let's see here. Which has been for J. Okay, so question, Sean. JP Morgan and BlackRock were partners in the Bitcoin ETFs. I currently invest in JP Morgan, which has been going up all year. Slow but consistent for JP Morgan. Would you think it is up? Would I think it is up? Either it's up or it's not up. I asking me whether or not it's a good investment to invest in JP Morgan's Bitcoin ETF, I don't know. I'd have to think about that and do a little research before I answer that question, Sean. I don't want to blow you off, Sean, but I don't want to give you just a fake answer either. I want to be honest with you. So I'd have to do a little research in that area, Sean, before I can truly answer that. Let's see here. Somebody said, what books do I recommend besides your free one in the description? Listen, I'm a fan of people like Dave Ramsey. I'm a fan of people like JL Collins, JL Collins. I'm a fan of John Bogle. I'm a fan of common sense investing, right? Basic common sense investing. Let's see here. I don't have my stock market 101 book. Here it is right here. If you want to get going, this is a good book to check out too. If you want to get going on something, let me put it in the camera there. Stock Market 101. Check that book out. If you're new, and you can always check that book out as well. Pretty good book just to kind of give you some basics. And I like to keep it around for people that ask me certain questions or recommendations like you just did. So let's see here. Finally caught her live, Miss V. Yes, good to have you, Miss V. Let's see here. Larry said investing $200 a month for beginners. Is that okay? Larry, it's okay. Yes. But my question to you, Larry, is do you have the rest of your financial house in order? Do you have a fully funded emergency fund? Are you at least getting the match on your job if you still have a job and you're investing with your job? Do you get the match? Do you have debt on things that are going down in value? Have you paid off your debt on everything except a home, right? Do you have the four walls of your personal finances together, right? That's my question to you. If that's okay, $200 a month is great. Wonderful. It's great. It's a great amount. And I don't know your age either. Can you stretch it beyond? You said 200. I'm going to ask you, why aren't you investing 300? What's the hole up on 275? Why aren't you go ahead and invest in 350? That's my question to you, because I want to challenge you and push you and encourage you to stretch yourself, right? Eat out, eat a meal outside the home 2 less times a month and make it 250. I'm just saying, why not, right? Let's see here. Somebody said, question, would you purchase VO ETF at the price is now 480? Yes, I would probably purchase VOO, which VOO is one of my favorites, right? VOO is the S&P 500 index fund from Vanguard. I would purchase it, but I would dollar cost average it too, right? I would just be purchasing it and just have it, keep it for the next 15, 20, 25 years. Just keep some VOO and keep buying it. You're buying the S&P 500. That's the top companies in America. You know, are the top companies in America sitting in the bucket? Are they all going to collapse at one time? Probably not. Right? If you study the guys I just mentioned, Bogle, Buffett, you name it, these highly wise investment guys, they always say the S&P 500 is probably the easiest and best investment for most people to do, because it's probably going to, if you believe that American businesses are going to increase and go up over time, then you should be investing in an S&P 500 ETF or index fund, right? So let's see here. Is the sign of the total market going to be the moon? So listen, guys, I just want to have this brief conversation. I said it was going to be a quick live. It wasn't a quick live. I'm sorry. I apologize. Please forgive me. The Fed's going to keep the cost of money high. They may not even cut rates they probably won't cut rates in May. They more than likely, in my opinion, won't cut rates in June. I could be wrong, right? I don't know this for sure. But again, the stock market is pricing in, I think, a 50 or 55% probability that the Fed won't cut rates, right? Of course, the inverse is true as well. Did I say Jack Bogle, John Bogle? All right. So I just want to have this conversation with you guys. I appreciate you being here. Thank you so much, Mr. Biz. Thank you so much, Pedro. Thank you, Eddie. Thank you, Clint. Thank you, Sunset on the Ocean. Thank you, Larry. Thank you, Miss V, for being here. If you didn't catch it, rewind this thing all the way back to the beginning. I got a special live I'm doing this weekend. I'm not for sure if it's Saturday or Sunday, but the next live will be on Saturday at 11 o'clock a.m. Central Standard Time. Check the description box below. If you're interested in saving money on your cell phone usage, your cell phone premium wireless plan, you need to check out Mint Mobile. There's a link to that below, guys. This is just like using, you name the top mobile company. This is the same exact thing for a lot less price. Mint Mobile. Check them out in the description box below, guys. So I appreciate you being here. Thank you so much for hanging out with me, guys. And as I always say, the best person who's going to take care of the old you is the young you. Take excellent care of yourself, because you're people too, but also take good care of other people as well, right? Until the next video, peace.